welcome to Leading on Logistics, the executive membership podcast from Logistics UK. Mike Young back with you as we bring you insights from and analysis of the country's logistics sector. In this latest instalment, we'll be focusing on financial confidence within the pages of the latest logistics sector mergers and acquisitions index for 2026. It's this that has the thoughts of more than 100 senior executives in the UK's logistics firms.
The current state of tariff code changes is dampening volumes and having an adverse effect on consumer sentiment.
Impact of the continuing 4% increases in national minimum wage means investment hurdle rates become higher than they otherwise need to.
We're not planning any further M&A, but many competitors are ready to sell as making a profit is becoming too hard.
The consolidation in transport and warehousing means companies with the right systems and infrastructure will become more desirable.
Industry profits are falling back to below pre-COVID levels. All costs, including labour, have increased significantly and continue to do so.
That's just a few of the contributions to this 2026 Mergers and Acquisitions Index, which we'll be chewing over in this latest edition of Leading on Logistics. To our guests we go then. Philip Bird co-authored this report with Phil Roe. Philip is a partner and expert in corporate finance at the accountants and auditors RPG Crouch Chapman. He's also their head of logistics. Phil Roe is Logistics UK's president, formerly of DHL and XPO. Philip, turning to you first, this report you've co-authored takes in the thoughts of a good chunk of the senior execs and logistics firms, covering business confidence, assessing productivity, the impact of things like decarbonisation now, all with an eye to the year ahead and what we'll see when it comes to mergers and acquisitions in 2026. Last year, this index had risen to a score of 50.2 out of 100. So to the layman, it was back to feeling sentiment in positive territory. This year, we're back below that all-important 50 figure and sitting at 46.2. Negative territory. In a nutshell, this latest report's talking about a mildly downbeat outlook. Can you give us some clues, Philip, as to why?
Yeah, well, I think the sector, like many other sectors, has been facing and will continue to face, some key challenges around cost pressures, economics growth, skill shortages, and of course that creates uncertainty. And in an environment of uncertainty, people want to take less risk. So that's translated into wanting to undertake M&A activity. But that's really a continuation of a trend we've seen, Phil and I, over the 5 or 6 years that we've been doing this report. Only on 2 occasions has it actually been in positive territory. I think immediately after COVID, and last year it was marginally positive at just above the 50 levels. So we're not surprised we've seen a fall based on those circumstances and issues we've mentioned, and particularly the autumn statement and the increases in national insurance, which have just translated into higher costs for operators.
Phil, let me bring in the T word, if I may. That could be Trump. It could be tariffs. We feel like this is a roulette wheel of trade confusion we're living through, isn't it?
Certainly, it's been a few up and downs, and lots of days have produced lots of different policies and statements. Fundamentally, a big part of a trading nation's wealth generation, and we've always been a trading nation, is driven by the amount of international trade you do. The more uncertain you are of your returns on that, and the less you do, and that's certainly the impact on tariffs. I think obviously the government did well to negotiate a different kind of tariff deal, so I suspect it probably could have been worse. But I do also think that one of the other effects of this uncertain trading environment is people do look at where they source from, and they start to maybe look with more of an eye towards a resilience and potentially being closer to home.
Philip, your thoughts on that?
Yeah, it's funny, isn't it, Phil? I think tariffs have only become a frontline theme, of real significance since Trump's come in. And I think the fact that it's emerged as a frontline theme now, they've always been around clearly, but I think as a weapon that Trump is using for, cooperation with international countries around the world has become a major thing now. And I think as a result, it's going to continue to be that, very much at the forefront of, Trump's policy to ensure, cooperation with international business partners.
Yeah, and it's obviously not being used for business purposes in many cases either. And this is we've had events like this in history before. Ultimately, though, as a economic student myself in the past, I believe that tariffs lead to higher prices for consumers.
You've mentioned this already around perhaps trading closer to home. And I mean, it would have been interesting to take another poll right now when it comes to geopolitical volatility at the moment. That in this latest index, there seems to be that feeling that it is safer to be operating, trading closer to home, mergers and acquisitions within the UK or at least the EU. Phil, your thoughts on that?
I mean, we've seen actually in the last few years some pretty big mergers that have been initiated from outside of the UK into the UK, particularly through the shipping lines looking to extend, and the ports operators looking to extend. So there's clearly still an attraction to being able to provide joined up offers for customers, particularly when operating over geography. I think the issue that we're seeing with this index is the uncertainty in the UK economy, particularly, and I think a lot of that really revolves around activity levels and growth.
Philip, your thoughts?
Yeah, one of the interesting findings of our report, which backs up what Phil's saying, is that many more participants are looking to do their M&A in the UK and Europe, which is a big switch from our last report. It was very much US focused and very little in Europe, and there's clearly reasons driving that, the whole geopolitical situation, the need for Europe to become a much stronger unit financially and from a defense point of view. But I think the other thing is that inflation in European countries is much lower than the UK. In places like France, Italy, Denmark, it's less than 1%. So I think, UK operators should see a chance through investing in Europe, through M&A, to actually see that as a cost-lowering opportunity for them.
And Phil, it's intriguing, I think, that here we are approaching the 10th anniversary of the UK's vote to withdraw from the EU, and yet here we are now talking about closer ties with the EU.
I mean, this whole really, the closer ties all does revolve around the economics rather than the politics of this. And, at Logistics UK, we always say we are fiercely apolitical. We support the industry and the industry in all the political circumstances that we find ourselves in. So, but fundamentally, the economics of the situation say that I think there were 22,000 less small businesses now trading with the EU than there were before the Brexit deal was implemented. So a lot of businesses are choosing not to. Some businesses have made some fantastic investments to try and make it simpler for their customers to do so. I was at a celebration early on in the week, actually, at one of those customers down in one of our members in Dartford in Kent, showing the IT investment they'd made to help customers be able to trade across the EU. But fundamentally, when supply chains get disrupted and the geopolitical situation makes you less secure, you're going to go closer to home, and it's just business sense, really. And I think if the government can continue to build on the work that they're doing to help the economic situation, then I think that's to the good of the country, really.
Clearly, there's an overwhelming economic argument. If you're facing increased costs and tariffs of, our biggest trading partner, the US, but there's the same opportunity in Europe and it's much cheaper and you don't have the barriers, where you're going to go. It makes sense, particularly in static economic conditions.
And let's look at it, gentlemen, through the prism of what we're seeing in the last week. Here we are recording this podcast in early March. Not just ongoing conflicts, Ukraine, Gaza, but of course now we have to factor in the impact of Iran, Iran's response to that. When we talk about volatility, it's pretty staggering what we're looking at here.
Yes, I mean, if I can kick off, Phil, I mean, I think clearly there's a lot of uncertainty around how long this war is going to, to last. The short-term impact is obviously going to be, higher energy prices down the line, which will generally filter through into higher inflation, which means interest rate reductions are more difficult in the UK particularly. But what worries me, I think, about this latest crisis is even if it's short-lived, the whole mood of uncertainty of what the US administration may do next and what the consequences of that may continue after the war and continue to contribute to increased uncertainty. And that just translates into, more difficult conditions.
Yeah, I agree with that, Philip. I really do. I think when you look at it, yes, there's an immediate spike on oil prices, but the real story is the spike on gas prices and the impact that that could have upon energy prices, which are already, the worst in Europe, in the UK. What impact that has on the consumer? Combine that with a softening growth position, I think anyway in the economy, and I suspect we'd have a slightly more gloomy than 46.2 if we did the survey now. So I do think that longer term impact, once you get past the hedge periods on the consumer, I think is going to be a real issue here if this lasts. Well, no matter how long this lasts, but also more critically, what happens in the Straits, even when you get to a cessation of hostilities, because it's the sensitivity of the Straits that leads to the spiking in prices, the huge increase in insurance costs, and the rerouting of international trade.
We've had the Chancellor's spring statement in this very week where we're recording this conversation. GDP growth expected at 1.1% for this year, 1.6% in 2027 and 2028. Unemployment supposedly to peak later this year. Inflation and interest rates on a downward trajectory. This is very much so what's coming out of the index that I'm reading, but the Chancellor seems to be backing that up too. Are we seeing more economic confidence now compared to, say, a year ago?
I think in the early parts of the first few weeks of this year, I think there was a feeling, certainly amongst the companies that I was speaking to, that things are going to get better. It may be maybe a slow recovery, but there are what one would call the green shoots of recovery. I think it's difficult to see those green shoots blooming into spring blooms over the next sort of 3 to 4 months with what's going on in the Middle East.
Yeah, I think the answers are very maybe really. I think there were when I talk to different members, it's very patchy. Um, there are a few that who say their volumes are up. Most of them say they're not. Most of them say that January, February has been flat or below what they expected. So that's what I hear anecdotally. Yeah, I think in a way, the spring statement against a backdrop of what then started last weekend, it kind of feels like that it's been superseded a little by events. And so I think there was maybe a little bit more confidence, but I think everything is now firmly in maybe land, until we see what happens over the next month or so, I think, over there. And of course, the other impact that this is gonna have, and we won't see this immediately, but the country is gonna have to spend more money on defense. It's already, made those commitments, albeit not with a timeline. But you can imagine that if this carries on, that timeline is gonna be coming towards us. And there isn't a huge amount of wiggle room in what the government can do.
No, and I think so. I mean, two interesting things came for me, Phil, out of the auto. So one was the downgrading of economic growth by
Yeah,
the
definitely.
OBR. Clearly, we're in negative real growth territory now, which is not good news for anybody. I think the thing as well, which, you know, clearly the Chancellor wasn't able to say yesterday, is that, you know, if this conflict goes on, interest rates are going to go up. That's going to push the cost of borrowing up. The increased defence spending that you mentioned, Phil, has got to happen. The government's going to overshoot its borrowing targets. and that there's that would seem to be the logical conclusion if events roll out in the Middle East, over the next months.
I think that's an emphasis very much on the events of the moment overtaking everything, really, and it's a watch, a wait and see. I mean, I'm fascinated to see the next index in a year's time, to be honest, because that will start covering so much of the ground that we're trying to look into the crystal ball for now. Let me mind more deeply on a couple of areas, though, gentlemen. I mentioned unemployment. Where are we with recruitment in the logistics sector now? I mean, I read in the index, increased labour costs are a key concern.
Yeah, let me start with this one. This is a conversation that I have with a lot of members. Um, the I mean, the logistics sector is unusual in that it's growing in all regions of the UK, and that's because the way we can choose to consume goods has got higher logistics content over time. So we're 2.7 million people, 8% of the UK workforce. The constituency next door to where I live, 25% of the MP's constituents work in the logistics industry. So we are a big employer. When I talk to members, they're continuing to hire, they're continuing to also react to what they see in terms of activities coming towards them. A lot of people are looking at technology and efficiency to see how they do things going forward. But that's what the industry does. The industry has always been a place to look to improve, to drive productivity, to drive efficiency as well. So um, at the end of the day, the consumer and GDP and the economy drive what is needed for logistics. Yeah, nothing moves without us. Every sector that has physical supply chains needs logistics, and in areas like construction, it's hugely logistics intensive. So I am sure, will continue to offer great opportunities as we do. If you look at our Generation Logistics campaign, shows all of the amazing roles that exist within the logistics industry. But when you're faced with higher costs, which all of us are, not just our operators, because we also represent retailers and manufacturers and operators of infrastructure, but all of those have got higher costs as well. So as a result, it's only natural, I think, that the more speculative end, perhaps, of recruitment is going to diminish, because fundamentally the costs are going up, and that then knocks into the differentials of people that are already employed. I don't know how it looks for you, Philip, but that's how it feels to me.
Yeah, I mean, I'd endorse all of that, Phil. Obviously, skill shortage has been a core problem for the sector over many years, and that's reflected in our in our numerous surveys. From an M&A point of view, I've seen very little shakeout in terms of people having to lose their positions because of takeovers, acquisitions. I think, in fact, that can sometimes be a driver for consolidation, getting the right people. That you couldn't ordinarily recruit. It's probably much quicker to do it through an M&A route. And I think the increasing use of technology is helping solve that skill shortage, but you still need lots and lots of personal contact, relationships, people doing the shifting and moving within logistics. That will never get away. So I always do think it'll be a sector of high employment, most definitely.
Yeah, and just to sort of build on that a bit, Philip, 3 years ago, we surveyed careers officers who are in all secondary schools. Yeah, you have to have one in every school in the UK. Only 2% of those careers officers knew anything about logistics or had any materials that they could share with their students to talk about jobs in the logistics sector. We just had the results of Generation Logistics Year 3 campaign. We moved that to 68%. So
Wow.
yes,
How have you done that?
but by creating a first ever careers guide, which is then
Awareness, yeah.
free and available, and a fantastic social media campaign that also lifts and showcases our brilliant sponsors and the great jobs that they have using young people to tell their stories. So yeah, it is a tightening situation, but even in that tightening situation, I think we're managing to increase the attractiveness of the industry to young people.
Yeah, I mean, that's great. That's great, isn't it? But it's got to convert into actual people wanting to
Yeah.
follow a career for it, and that will come in due course, I'm sure. Increasing awareness is obviously the first thing, and making it more attractive.
Absolutely, it is. They're not going to come to a career they know nothing about.
Certainly, the report highlighting that need for skilled staff, the number one productivity challenge. Another stat for you: future intentions, 68%, so more than two-thirds, say they're unlikely to undertake mergers and acquisitions over the next 12 months. That's a little bit more than the 65% who said that last year. I do wonder, though, is there a feeling that the groundwork is still being laid this year for mergers and acquisitions further down the line?
Oh yeah, definitely. I mean, I think 2025, most M&A, the deals we've been involved in were largely for defensive purposes to achieve economies of scale, efficiency. You could argue that in a more difficult and challenging economic environment, there's a better case for bigger M&A transactions, and of a different type that move you in a different part of the supply chain than you are at the moment. Really, again, to increase customer penetration, to improve margins, and all that. So, out of the difficult conditions, may come bigger transactions, and that would be great news, I think, for the sector. A lot of it's been small scale, but again, in 2025, but again, our latest report suggests that, you know, bigger deals are on the horizon. So the 10 to 50 million pound transaction range is where the most of the action is contemplated through the rest of this year.
Yeah, I'd agree. I'd agree with that, and I do also agree that if things do get tighter, that actually it makes it more likely that we'll see transactions as people look for the benefits that can come with M&A, and also maybe some people look to get out as well. And I know loads of examples of that that have happened over the last 3 or 4 years, where particularly maybe some family businesses have just taken the decision that they're not going to carry it forward. Um, so I don't think that that percentage. I believe it was 68, Mike, you mentioned. I think it's always been around that kind of a level. Um, you know, and and I don't think, unless it became 85, I'm not sure it's a massive change year on year.
Improving efficiency, a big driver in mergers and acquisitions activity. Is this the bigger firms looking to boost their resilience? Phil, you talked earlier about adopting a defensive position in these troubled times.
I mean, the motivation, my experience of this, from my background is that there's very different motivations for M&A. The biggest motivation I saw was really about obtaining either greater depth with a particular customer organization, or a broader service offering. Now, I think that was probably in better economics times than we've seen over the last 10 years. So seeking benefits of scale, getting particularly benefits on utilization, I think are also often cited as key reasons. But I think in our sector, where the unit of operation is largely a depot or a fleet, sometimes carving out those efficiencies is quite hard to do. So, you've really got to be sure that plan fits in order to, because most people are involved in operational day-to-day delivery. That's what most people work at. So it's yeah, there's definite good examples, but it's sometimes quite tough to achieve.
Yeah, I mean, we have seen a rapid expansion of companies providing technology software, particularly into the logistics sector over the past few years, whether they're just better transport management systems or warehouse management systems, or software that enables you to buy short-term space when you're full, things like that. all again designed to sort of help improve efficiency planning, which comes through into better cost control and ultimately margins. So it's definitely a key theme at the moment. Increased use of technology across the different parts of the supply chain to achieve those efficiencies.
There was a stat that I thought was quite interesting in the index, which was well over half, 61% of respondents looking to increase investment in their business over the next 12 months. Now that's up from 56% last year. Where's the spending going to be?
I think one of the areas that we'll see more investment being made is in technology supporting decarbonisation. I think we've the number of vehicles that we've got in the UK that are moving that is inching forward, but I think a lot of companies are experimenting, they're learning, they're applying, and actually particularly the electric vehicles are getting better and better with each release. So I think we will continue to see investment in those areas. I don't think it'll be huge um, scale adoption at this point because we need the infrastructure in order to do that. But I do think that'll be one area where we'll see more investment. I don't know if you saw any other areas, Philip.
Well, I certainly think the green and the ESG agenda is increasingly up the agenda for all logistics companies, not just the large ones. So I think that's the theme, and customers want to see that commitment for it, whether that's greener vehicles or just generally ESG. I mean, I think the other thing I've sort of noticed over the past 12 months is particularly for warehouse operators, they're looking to invest in more regional warehouse type structures because obviously with local delivery now, time sensitive delivery, it's a very competitive world, last mile delivery, and you have to get it right. I think there's companies are definitely looking at their warehouse footprint around the UK to enable them to do well in that particular segment of the market.
And I think building on that, we're also seeing increasing use of automation for a whole range of different tasks across the warehousing footprint in particular, and a lot of those small scale adoptions, robotics and things like drones for stock counting, they're actually got a reasonably good payback, and so I think we'll still continue to see not just big scale automation, but I think we'll continue to see an increased amount of small scale automation across the warehousing footprint as well.
And Philip Bird, I wonder if in future indexes you and I might be talking about the role for artificial intelligence more and more. Your thoughts there, both of you? Philip Bird first.
Well, yeah, I mean it's obvious it's going to have an impact. In fact, interestingly, I was reading a report came out a couple of days ago by Moody, who sort of modelled three or four different impacts of AI across the business world. And the one that came out as most probable, with a 45% probability, is what they call the AI empowered economy, which produces brisk and rapid improvements of productivity, but does not trigger major job losses. Now, I think everybody thinks there will be some job losses, but I think used in the right way, and I think logistics companies will be particularly aware of the need to retain staff going forward, that they will see IT as a enhancer rather than a reducer of their productivity through their staff. That's my view anyway.
Yeah, I'd really agree with that. I think AI applied gives logistics companies the ability to find efficiencies and to take on work in a way that they haven't done before. And actually, I think that will. I don't think it will drop employment particularly. I think it'll enable new and different business models to be involved. I'm working as an advisor at the moment for a program called Transit, which is being run up in Glasgow, which is looking at building digital twins for the UK transport industry and comparing them with digital twins for climate change. And those sort of things would be unheard of without AI, and will give us insights into what we should do going forward as a nation, as well as looking at those microeconomic implementations.
Final word from you both, if I may. We've covered a lot of ground in 30 minutes or so, but government policy is impacting strategy or delaying investment. That's according to 69% of those polled. Here we are, approaching 2 years of this Labour government. Phil Roe, first of all, your message to that Labour government, if we were to conclude this edition of the podcast with a message from each of you to that Labour government 2 years in?
Well, I'll repeat what I said to the Chief Secretary of the Treasury last Thursday, which is the only route out of the additional costs that have been put into employers and into the economy is to grow the economy. So the focus has to be on creating growth. And that is partly investment, particularly in infrastructure, because if you make the logistics industry better by infrastructure investment, every other sector benefits at the same time. But fundamentally, it's got to be about improving growth in the UK economy as a whole.
Yeah, I absolutely agree with that, Phil. I mean, there's two parts really to this question. There's what they could do to support the sector, in terms of helping companies achieve their decarbonisation objectives. That's one thing. But I absolutely agree with Phil. The UK logistics sector depends upon the strength of the UK economy, and until we have a more rapid growing economic environment, it's going to continue to be tough for all companies across the sector, but particularly logistics. So any policies to stimulate growth will obviously help very, very much indeed, and are to be encouraged.
We will watch and see the decisions being taken in 2026 and the impact that they have. Leaf through the pages yourselves of the UK Logistics Sector Mergers and Acquisitions Index 2026 if you want to find out more about what we've been discussing in this last half hour or so. Philip Bird, Phil Roe, my thanks to you, and I look forward to being with you again with the next edition of Leading on Logistics, which is a Broadcast Revolution production for Logistics UK.